Let's define internal control. Internal control is a process affected by the entity's board of directors, management, and other personnel designed to provide reasonable assurance regarding achievement of the entity's objectives relating to operations, reporting, and compliance. Internal controls over financial reporting are preventive controls aimed at avoiding the occurrence of misstatements in the financial statements. An example is segregation of duties. Detective controls that are designed to discover misstatements after they have occurred. An example is the monthly bank reconciliation. Corrective controls are those needed to remedy the situation uncovered by detective controls. An example is the backup of master files. And we also have controls overlap. These may be complementary, they function together, or they may be redundant. They address the same assertion or control objective. Compensating controls reduce risk. Existing weakness will result in misstatement. If we have a weak control, we may create another control to compensate for the weakness. The components of internal control are the control environment, risk assessment, control activities, the information system relevant to financial reporting and communication, and the monitoring activities. We will talk about each one separately. The control environment is the umbrella over the organization. Control environment factors are commitment to integrity and ethical values. The board of directors demonstrating independence from management and exercising oversight of internal control. Establishment of effective structure, including reporting lines and appropriate authorities and responsibilities. Commitment to attract, develop, and retain competent employees. And holding employees accountable for internal control responsibilities. The risk assessment process clearly specifies objectives to allow the identification and assessment of risk relating to those objectives. Identifies and analyzes risk to the achievement of its objectives to determine how they may be managed. Considers potential fraud relating to the achievement of objectives, and identifies and assesses changes that could impact internal control. Control activities are all the policies and procedures that help mitigate the risk that the organization's internal control objectives are not met. These include performance reviews like comparing budget to actual, transaction control activities such as approvals, verifications, use of forms and documents, reconcilements, and supervisory reviews. Physical controls to include inventory counts, locking doors, and controlling access. It should be noted that segregation of duties is a basic concept that dictates that one person should not handle all aspects of a transaction from beginning to end. Segregate authorization, recording, and custody of assets. Objectives of the accounting system include identify and record valid transactions, describe on a timely basis the transactions in sufficient detail to permit proper classification of transactions, measure the value of transactions appropriately, determine the time period in which the transactions occurred to permit recording in the proper period, and present properly the transactions and related disclosures in the financial statements. Ongoing monitoring activities include regularly performed supervisory and management activities such as continuous monitoring of customer complaints. The activities of the internal audit department is another form of monitoring within an organization. Limitations of internal control include errors may arise from misunderstandings of instructions, mistakes of judgment, fatigue, etc. Controls that depend on the segregation of duties may be circumvented by collusion between two or more employees. Management may override the structure of internal control, and compliance may deteriorate over time. The auditor will document their understanding of the system of internal control through the use of questionnaires that are typically standardized by the CPA firm, written narratives and memos that describe the flow of transactions, flowcharts, and walkthroughs wherein the auditor traces one or two transactions through the operating cycle. The auditor's approach to the testing of controls is identify controls likely to prevent or detect material misstatements, and perform test of controls to determine whether they are operating effectively. Test of controls include inquiries of appropriate client personnel, inspection of documents and reports, observation of the application of the controls, and reperformance of the controls. The results of the test of controls are used to determine the nature, timing, and extent of the substantive procedures. Say that again. The results of the test of controls are used to determine the nature, timing, and extent of the substantive procedures. This is a very important concept in our world of auditing. The work of internal auditors may be used by the CPA auditors in two ways. They're used to obtain audit evidence by using the internal auditor's work performed as a part of their normal responsibilities, and using the internal auditors to provide direct assistance on the external audit. The organization being audited may outsource an operation. If the outsourced operation relates to the financial reporting, then the auditor, known as the user auditor, must consider it as if it is part of the company that they are auditing. A good example is payroll. Many companies have their payroll accounting done by an outside service organization such as ADP. The user auditor still has to deal with the payroll accounting to include internal control when she audits payroll expense. Most service organizations provide similar services to many clients. It is unreasonable for the user auditor of each of the service center's clients to visit the service center to evaluate internal controls at the service center. Instead, the service center will engage its own auditor, the service center auditor, to prepare a report on its internal control known as the Report of the Service Auditors. There are two variations. A Type 1 Service Auditor report describes the system and the suitability of the design of the internal controls. A Type 2 Service Auditor report describes the system and the suitability and the design of the controls, plus provides assurance as to the operating effectiveness of the controls. A Type 2 report is normally obtained by the user auditor in order to be able to rely on the internal controls at the service center. Certain internal control deficiencies are classified as 1. Significant deficiencies. A deficiency in internal control that is less severe than a material weakness in internal control, yet important enough to warrant the attention by those responsible for the oversight of the company's financial reporting. And 2, material weakness is a deficiency in internal control over financial reporting, such as there is a reasonable possibility that a material misstatement of the company's financial statements will not be prevented or detected on a timely basis. Auditors are required to communicate both significant deficiencies and material weaknesses to management and those charged with governance. Due to the lack of employees, internal control is seldom strong in small businesses. Specific practices for small businesses include: record all cash receipts immediately, deposit all cash receipts intact daily, make all payments by serially numbered checks with the exception of petty cash disbursements, reconcile bank accounts monthly and retain copies, use serially numbered invoices, purchase orders, and receiving reports, issue checks to vendors only in payment of approved invoices that have been matched with purchase orders and receiving reports, balance subsidiary ledgers with the control accounts, and prepare comparative financial statements monthly to disclose significant variations in any category of revenue or expense.